Hello, everybody. I'm Scott Inman, along with me, John Shrewsbury. Welcome to Outlook 2024. Yes, it is a new year, second month of a new year, and we're going to talk to you for the next 30 minutes or so today about the economy, about the stock market, about bonds, and really how to prepare for what may or may not be coming in 2024 or beyond. You know, John, we do these outlooks every year and sometimes twice a year. LPL Research provides us with a lot of information. We're going to use another partner or two today to kind of bring it all together and talk about. But the reality here as we get going is what's happening over the next 12 months is kind of like where we were with Outlook 2023 or Outlook 2022. There's a lot of uncertainty.
There is. And, you know, we have subtitled this outlook A Path Through the Forest. And if you stop and think about it, a forest can be pretty intimidating. It can be dark and gloomy and full of all kinds of creatures and things of that nature, all kinds of threats. But a forest can also be teeming with life and teeming with opportunity. And there are certain things in the forest that you can find that are very positive if you know where to look. And I think that's really where we're going with Outlook 2024 is that, you know, there's a lot of concern, but there's also a lot of opportunity if you know where to look.
May just not be as present, as in the light, or as broad of a path.
That's right.
As it sometimes is through the forest. So we're going to try to give you a machete or two to cut your way through that forest today.
And there's plenty to cut through. Obviously, there's always something to worry about, Scott. Mm-hmm. And when you think about worries, you know, all you have to do is turn on the TV and you can find plenty to be concerned about.
Yeah.
What you don't really obviously see are some opportunities. And we're going to try to highlight some of those. We're also going to give you some a little bit of caution in some areas that we think that caution is actually deserved.
Yeah. So when you think about where we are with the global economy, and we'll spend a little time looking backwards here, but it's always good to get that hindsight or get that perspective as we look forward. We are now in the wake of one of the strongest periods and fastest periods of interest rate hikes really in American history. When you look at what the Federal Reserve has done over the last year and a half to 2 years prior to the new year this year, it was really almost unprecedented to see rates go up as high as quickly as they did. And there was no doubt that that really created a ripple effect on the economy. And of course, they did it, John, to battle inflation. And it looks like at this point in time that was a battle that was won.
Yeah, and a lot of people thought that the Fed raising interest rates would tip us over into a recession. And frankly, a lot of the pundits out there have really, hung their hat on a recession in 23, and they're hanging their hat again on a recession in 24. But Scott, I heard Chairman Powell talk about this just last Sunday night, talking about the fact that the pandemic really kind of created a different set of circumstances in the economy, and raising interest rates did not really throw us into a recession, and he doesn't think that they will continue to do so. So as we begin 2024, we see that those the prompting for raising interest rates, which was inflation, we see that beginning to trend down. Now, it's not exactly where anyone wants it to be, but it's a lot better than it was, let's say, 18 months ago when inflation was really kind of a shock to a lot of senses in the investment world.
Yeah, and we talk about this with clients pretty frequently, that we look at the interest rates where they are compared to where they were, right, just a few years ago. So interest rates are certainly higher. And then when you hear this concept of, well, we expect them to be higher for longer. But relatively speaking, or at least looking on average, interest rates are pretty much the norm right now. Interest rates have certainly been much higher. In fact, if you look at the statistics, the Fed fund rate between 1971 and 2023, the average Fed funds rate was 5.42%. And that is right smack dab in the middle of the range that we're in right now. And inflation, the long-term inflation rate in the United States between 1960 and 2022, 3.8%, right in the range of where we are right now. Now, I know the Fed wants it at 2%, and there's nothing wrong with battling it to try to get it to 2%, but I think it is worth taking stock in the fact that where we are right now is not some hugely inflated number. It's relatively average.
It's all about perspective, Scott. I remember back in the probably the early 80s, I borrowed some money to do some repairs on the house I was living in. And the house that I was living in needed about $5,000 worth of work. And I borrowed $5,000 at 12% interest. Now, a lot of people would think, wow, that's just exorbitant, but that was the going interest rate at the time. And I think we have been lulled to sleep to some degree with these low interest rates. They've been abnormally low for a long period of time, and everybody got to thinking, well, that's just the norm. It's really not. As Scott said, it's really more about a 5% interest rate on the Fed funds rate standpoint, and that's where we sit right now in this economy, and we think that those rates will start beginning to tick down just a little bit. But Scott, obviously we have had some softening of some consumer sales that, early on in the pandemic, people were buying things like crazy. Mm-hmm. And we've seen that soften, but I think that was really kind of a reversion to the mean, so to speak.
Yeah.
And so what we're seeing now is people spending money a lot on experiences, travel, things of that nature. And it's sort of that experiential economy that people are really more gravitating to. So it's sort of a shift. It's not necessarily a stoppage of spending, but it is more of a shift in the economy.
Yeah, when you look at the global economy in transition, just to kind of recap those things that we're talking about, we've got a slide here that points it out. Inflation is going down. And at the same time, we're seeing a softening consumer goods sales and service sector stability. So to John's point, it really is a transition. It doesn't necessarily mean a recession is coming. It just means that one particular part of consumer spending may be slowing down while another is ramping up. And you think about this when we talk about being home during COVID and everyone was buying things on Amazon every day because they were at home all day, and the consumer goods were definitely ramping up. Sales of consumer goods were definitely ramping up. It is amazing to me to think about how that's been almost 4 years now.
It has been.
And all of that government stimulus money, you still hear it talked about, that was the reason why, right? People were not working. They were given money, and they used that money to spend, and they had more than they needed, so it was going to take a while for it to circulate through the economy. It's amazing to me to think about how that took 4 years, or we're just now seeing the end of that. But you knew at some time that was going to end, and we're seeing that effect for sure.
Yeah, you are. And so when those cash reserves have kind of dwindled a little bit, what you're also seeing is a little bit of a rise in some delinquencies that are out there, especially in the lower end of the economy. And Scott, obviously, when people are living on margin, when they get back to that situation where they don't have extra cash, then all of a sudden they begin to resume some of their ways of not paying bills on time and things of that nature. Also, we've seen a situation where student loan debt has resurfaced because during COVID, student loan debt was suspended. The payments on student loan debts were suspended. And of course, the Biden administration has gone through all kinds of leapfrogs or jumping through hoops trying to get rid of student loans. They've done this in tranches around a Supreme Court decision that said that they couldn't just forgive all the student loans, but they've done some in certain cases, and they're still trying to do that. But what the result of this has been is that loan payments, that is, actually resumed in October. And so you've had that hit the economy, taking spendable money out of people's pockets. And when you're on a narrow margin anyway, when you have another payment that resurfaces that you haven't been used to in the last 2 or 3 years, then that can be a real problem.
Yeah, and everything costs a lot more than it did before COVID began too, with all of the inflation that we've gone through. And it is worth pointing out too, I've got some numbers here or some data from a recent report to talk a little bit more about the delinquencies. But you think about the inflation rate only being at 3%. Well, that doesn't mean, of course, that prices are going down. It just means they're rising at a slower pace. So we are still seeing the cost of living really take its toll on lower income households, on any household that doesn't have margin to absorb that increase in expenses. And that's why they've turned to credit, because really people are not going to slow down their spending unless they lose their job or they run out of credit. And certainly the unemployment rate is still very low in this country, so that is not happening, but they are beginning to run out of credit. A recent report from the New York Fed finds that early delinquencies on auto and credit card products began rising for low-income borrowers in 2022 through the third quarter of 2023, and it has now exceeded pre-pandemic levels.
So yeah, people back to their old ways of doing things, and that narrow margin that a lot of people live on is beginning to show up in those statistics. Now, Scott, there's lots of news out there that can worry you, but all is not bad about the economy. As a matter of fact, there are some tailwinds, and if you're a pilot, you know you want a tailwind that pushes the plane further along on its route, and you don't have to burn gas in order to get there. So let's talk about some tailwinds for the economy. These are good things. Interest rates, as we said, are improving. Home prices are moderating. You know, for a period of time there, we were going through a period where home prices were just jumping almost astronomically, that you could buy a house and 2 years later you could sell that house and make a very healthy profit. Well, that's kind of cooled off a little bit, as you might think, because mortgage interest rates are higher. When you've got cheap money and you can stretch it out for a long period of time, you can take some risk, and people did do that. They actually stretched out, bought maybe even more home than they could afford, and hopefully they didn't do that on an adjustable rate mortgage, Scott, because that will come around and bite them. But for right now, the home prices are moderating. So if you're looking for a home, absent the interest rate issue, you actually can buy a home a little bit cheaper than you could, let's say, in 21 or 22.
Yeah, and I think the inventory we still believe is relatively low because there aren't too many sellers putting their home on the market because they don't want to buy at a higher interest rate. But I find it very interesting, you know, when we are in this quote unquote higher for a longer period, eventually people have to buy homes, right? You know, we talk to clients all the time about their kids maybe thinking about buying a home, or are they going to buy their forever home, and they go, well, I'm going to wait while rates are high. They have the ability to do that, but there are still people getting jobs and changing locations, and they have to buy. So some of that will still be spurred on in that way. And I have read much about new home construction is getting more and more improvement in the outlook there. So the housing market, which is a big part of the overall economy, is definitely not in bad shape. And the other part, too, the biggest part of the economy is consumer spending. And we just talked about delinquencies and credit card debt, certainly a problem. But if you're not in that camp, if you're not in that boat, overall, consumers are maintaining resilience.
They are. And a preliminary study from the University of Michigan Consumer Sentiment Survey shows that Americans feel more upbeat than they have in many years about the economy. Consumer confidence increased 13% back in January to 78.8, reaching its highest level since July of 2021. Scott, that marks an increase. That marks the index's largest monthly increase since 2005. So a lot of positive things out there as far as the overall economy is concerned, a lot of good feelings, but still some caution is still needs to be maintained as we go through looking at how 2024 is going to play out.
You are fond of saying this, and I have stolen it from you in many occasions, but it's never as good or as bad as it seems. And if you watch the news, it seems like it is all bad. The economy is tail spinning out of control, but that is certainly not the case. Are there causes for concern? Yes. Is there a potential of a slowdown coming? Certainly. Maybe not recession. Probably not recession. At least in the outlook of 2024. But things are still moving. They aren't moving at the pace that maybe they have been in the past when we've had really large bull markets. But that does bring us to the stock market. So as we transition in this part of Outlook 2024 out of the economy discussion, let's talk a little bit about the stock market. With the transitory state of the economy, what does that mean for your investments? Well, let's take a look at, or start talking a little bit about where we've been in the market. And prior to this year, John, I had not heard the term the Magnificent Seven outside of the Old Western. But now you almost can't read a story about the stock market without reading about the Magnificent Seven. And what are we talking about? We're talking about the Magnificent Seven stocks, members of the S&P 500, but the big ones, the largest ones, the Apples, the Googles, those type of stocks.
Technology stocks.
Those mega cap stocks led the way in 2023. Those seven stocks returned 111% in 2023. The S&P 500 overall, of which those seven are members, was up 24%. So there's no question. They call it narrow leadership.
Yes.
That came from the Magnificent Seven in 2023. So how about as we look at 2024?
Well, in 2024, we believe that there are some real opportunities out there. If you think about those Magnificent Seven running up the S&P 500 and being very, very strong, a lot of the S&P 500 actually lag behind. So this sets up really an interesting opportunity for some of those stocks that have not actually performed as well as the Magnificent Seven. And there seems to be a consensus among our investment partners that the small and mid-sized companies, not the Magnificent Seven, not those mega stocks that are out there, but the small and mid-sized companies could hold an advantage in 2024 over their larger counterparts when it comes to investing opportunities. So, Scott, I think this is really an area that we need to dig into just a little bit, because I think really you can't just buy the index and expect this to work out.
Right. I think that one of our partners, Richard Bernstein Associates, he's actually been quoted as saying it could be even a once-in-a-generation opportunity to invest in places outside of the Magnificent Seven. And one of the points he makes, or the data he uses to drive this point home, is that if he looks at, they mined the S&P 500 to find the companies in there. And when you, again, just as a reminder, the S&P 500 is roughly 500 of the largest companies in the United States. So it's made up of a rather large group of companies. The index is weighted, and that's why the Magnificent Seven can pull it upward. But if you look at the year-over-year earnings forecast of all 500 of those companies, you'll find only 82 of them have a projected 25% growth or greater, okay? So of the 500, 82 project that they'll be growing at 25% or greater. Only 3 of those were among the Magnificent Seven. So 3 of the 7 were ranked in those 82, but the highest one ranked at 25th, and the other 2 were behind that. So when you think about 82 companies, take those Magnificent Seven out, you're still talking about 79 companies that have tremendous earning potential beginning in 2024 that are not the Magnificent Seven, and whose price, when it comes to per share, has not really lifted or has not really gone up like the Magnificent Seven.
Scott, as we sit here at Gen Wealth as independent financial advisors, we have the privilege and the ability to work with almost any investment firm that is on Wall Street these days. And so we have hand-selected some of our partners in the investment realm, and we use those folks every day. Now, I want to kind of run through just some quick thoughts from our investment partners about 2024 and what we could expect. Number one, we think that technology could possibly cool into 2024. You would expect that after a red hot 2023, you would expect some of those technology stocks to cool for a little bit at least. However, I really think that technology is just going to be a perennial favorite because of the place it holds in the economy. There's also cyclical and non-U.S. stocks that appear to be very attractive. And Scott, as I mentioned a little bit earlier, diversification may be more important than in the recent past. You know, for a number of years, you could buy the S&P 500 and you would come out pretty well. But we believe 2024 is going to be one of those difference makers of diversification, and where diversification is really going to show up in a positive way.
Yeah, and we'll get a little more into the diversification and what that means in just a moment. But I want to kind of circle back when you talked about technology potentially cooling. You know, technology long-term always seems to lead the way when you talk about growth in the stock market. And I love the analogy that one of our partners has made, that technology has really become to today's economy what oil meant to the economies of the 50s and even through the 80s. And I think about that, and the analogy rings home when you think about it's what we run on, right?
Yeah.
We used to run on oil, and we still do, right? But we run on technology. The world, I was just telling you before we went on, I had a bad tech day. I couldn't get in my computer. I couldn't do anything this morning until I got all of my tech problems solved. It shuts the world down when it's not working, and it makes the world run.
Yeah, it puts us in a kind of a vulnerable state if you think about it. But technology is so pervasive in the economy. Everything runs on technology, even the most simplistic things that you think about, like going to the grocery store. You think, well, that's a hard item. How did it get to the grocery store? There was a lot of technology involved in actually processing that package of meat or whatever you may be going to buy at the grocery store. So technology is just ingrained into our economy, and we don't think you're going to lose by investing in technology.
Right.
There just could be other opportunities out there in 2024 as technology kind of takes a breather for a bit.
Yep. Any pullback in technology would certainly be viewed as a buying opportunity for sure.
Absolutely.
If it does happen. So when we talk about, we want to quote Richard Bernstein again too. I love this. With all eyes on large cap growth stocks, we see bigger opportunities in international small caps and value stocks and inflation beneficiaries. So let's kind of dig into that. When we talk about large cap, that's the S&P 500, right? Those are the largest capitalized companies. That's what the cap means, capitalization. What about small caps? We've been talking a lot with our clients about, hey, the S&P's reached a new high. The Dow and the NASDAQ are encroaching upon a new high again. It seems as if what happened in 2022 is in the rearview mirror for those indices, but the Russell is being left behind.
Yes.
The Russell 2000, which is the small cap index, the all-time high of 2458 was set in mid-2021. Okay, that's been a minute, right? That's 20%, or currently the index as we are on the air right now is 20% below its all-time high. Now that in itself is not a reason to invest in small caps, but when you think about what's being left behind, and that's really what we're getting at with the Magnificent Seven bolting, but there are some other companies with some good earnings potential that are not growing from a stock price perspective. The Russell 2000 index is a good reminder that small caps have not rallied like the rest of the market has.
Scott, another of our partners, LPL Research, is taking a little bit more of a tepid approach to their forecast on the economy and the markets. And LPL Research says we forecast moderate but not spectacular returns for 2024. A glide down in interest rates could be offset by an economic slowdown. So, and that's been something that Jeffrey Roach and the team at LPL Research has been saying for a while, that they do expect to slow down. They didn't get it in 2023. Maybe they do get it in 2024, but an economic slowdown doesn't necessarily equate to a recession or even a negative performance of the stock market.
Right. When you think about economists, and we say this with no knock to economists, I mean, these are the smartest minds out there. We like to read them. We like to get a feel for what they're thinking. But the reality is there's always a divergence of thought. There is always someone who thinks differently, and they're not going to be right all the time. So you have to keep that in mind. But there is definitely a divergence from even the LPL research side and Richard Bernstein and Associates with where they feel like the economy is headed. So we've talked about stocks. We've talked about the economy. How about the fixed income market? I say that with a smile on my face now. A year ago, I didn't say that. 2022, obviously, bonds were just hammered, really because of the rising interest rates. The bond prices suffered greatly. But now the yields are higher. The rates are not going up like they were last year and the year before. So if we look at the fixed income market, John, we think that we could see positive things in the bond portfolio in 2024.
Scott, bonds and interest rates have an inverse relationship. We talk all the time about the fact when rates are rising, bond prices are falling. And when bond prices are being negatively affected like that, people who invest in fixed income get hurt. And that happened in 2022 and 2023 to some degree. Now, with a stability in interest rates at a higher level, they're earning a pretty good coupon on the bond. The interest that's being paid on that bond is actually not that bad. And there's an opportunity for bond interest rates to come down. Therefore, bond prices could ease up in 2024. And let's talk a little bit about why we want to own bonds. And this is always a question that comes up in the meeting room. Well, why do I have that? Because it doesn't return all that much. And especially in the low interest rate environments, people are really coming at us wanting to know why to have bonds. Well, let's go to school on this for just a second. Bonds provide diversification. Bonds give you that counterbalance to the volatility of the stock market. Bond prices are relatively stable unless you're in a rising interest rate environment. So diversification is key here. Also, bonds provide liquidity. You can sell a bond at the drop of a hat. You can. There's a very, very liquid bond market, so the ability to raise money is very proficient in a bond portfolio. Bonds also provide a healthy level of income to the bondholder. That is substantially different than the low yield levels of the past few years, and it's something that we believe continues to have a good spot in a client's portfolio. Let's talk about maybe some opportunities, Scott, in bonds that may be present in 2024.
Well, we're going to show you three. So we believe here are some potential opportunities in bonds. Treasury bonds. You think about that not being very attractive when yields were so low. Certainly yields are up now, and you're seeing the 10-year around the 4% level. And of course, Treasury bonds are backed by the full faith and credit of the U.S. government. Mortgage-backed securities, principal and interest payments there with little refinance or prepayment risk.
Scott, when you think about the fact that a lot of people locked in their mortgage payments in the 2, 3, maybe 4% range when rates were really low, now that rates are up in the 6 or 7% range for mortgages, nobody's going to refinance their mortgage and exchange a low interest rate mortgage for a moderate interest rate mortgage. So that poses a threat when there is a refinance opportunity. Then that poses a threat to people who hold mortgage-backed securities. But the current economy would not indicate that we would have that type of situation.
And one other we had on the screen there, laddered bond portfolios. You can buffer unexpected changes in rates that way and provide for lower volatility and moderate yields. And we use the word moderate, but we also did a fastest four not that long ago that was provided to us from LPL Research that even a slight drop in interest rates could turn your bond portfolio into an equity-like return, because if rates go down, to your point on the laddering, the prices would go up.
Scott, using laddering strategies is something that we do here at Gen Wealth. As a matter of fact, we have several portfolios that are laddered bond portfolios. And those laddered bond portfolios really give you an opportunity to have some rate and some yield diversification and maturity diversification. So you would just think about it this way. If you have a 1 through 10 year bond ladder, you have some bonds that are going to mature in a year, some bonds 2 years, 3 years, and so on. So what that does is it gives both a reinvestment opportunity if rates rise and some stability there, because you have maybe a longer term interest rate product in there that's going to give you a little bit higher yield. So it is a strategy that we use to try to get a little bit better yield and stabilize the overall portfolio value when interest rates are volatile.
When it comes to investing, John, we hear all the time a diversified portfolio of stocks and bonds. That's really all that most people talk about when they say, I have a diversified portfolio. There are many other asset classes available, so we do want to talk a little bit about that before we close. You may have heard the term alternative investments. So what is that? Well, it's an opportunity to invest in something that is not stock or bond. There are different kinds of alternative investments, and we'll talk about that. They are certainly tools of diversification. It is a way to, again, have a third asset class instead of just stocks and bonds. What's an example of it? Maybe managed futures, hedge funds, which can be riskier, and then real estate. And there are different ways to invest in real estate. You see that picture of a house on the screen. Obviously, that's your biggest investment many times, your own home. But what about outside of your own home? And we don't necessarily mean hard real estate, and we don't necessarily mean publicly traded real estate, but what about non-traded REITs?
Non-traded real estate investment trusts really do have some stability involved in them. They are buying real estate that is not traded on a public market, so there is no daily net asset value and no speculation in it and no effect of, let's react to this or let's react to that. There is some up and down of non-traded real estate. We saw rising interest rates negatively affect non-traded real estate in the last year or so, but we do think that there may be some opportunities. And as you think about real estate, you're going to hear a lot on the news these days about the fact that that commercial real estate, particularly commercial office buildings, are really taking a hit because people are working from home more. And there's some thought that maybe as much as a third of the office space in America could be compromised from an investment standpoint. But that's not the only opportunity that is out there. You have to look at things like data centers, things like warehouses, things like multifamily housing. These are all opportunities in the non-traded real estate market. Now, Scott, I want to say at the outset that owning non-traded real estate, you do have to be a qualified investor to be able to own that. The qualifications are not tremendously high, but not the average guy on the street can own that. But we do have select clients in portfolios of non-traded real estate that have good growth opportunities to them.
And they are also considered illiquid investments too.
That's right.
Unlike stocks and bonds in many cases where you can sell it and have it back in a couple of days.
Where that's the downside of non-traded investments is there is no public market for it that you can go in and create liquidity. And when you think about it, that makes sense. If you're in a, let's say a warehouse or a multifamily facility, then if you own that, then you're not going to go saw a part of it off and sell it to somebody to create a chunk of liquidity. You don't move that you don't make that real estate liquid in a quick hurry. So it is something that you have to have a long-term investment horizon and be comfortable with that. But it is certainly something that gives you some diversification.
And certainly I always want to point out that none of the talk that we had today was specific investment advice. We are just merely talking about what is available and might be suitable for some investors. But the reality is, we wrap this up, John, whether it's investments, the economy, where the market's going, it all comes back to having a plan, because most of what we just talked about, the largest percentage of everything we just talked about, is out of our control.
It is.
What is in our control is to make a financial plan that has an accompanying investment strategy that is a long-term investment strategy. You know, when you think about putting a plan together here at Gen Wealth, if we're in equities, if we're in real estate, we are talking about it from a long-term perspective, not just the outlook of 2024.
Yeah, that's right, Scott. And I think all this has to be taken into perspective of your own personal financial plan. So when you think about how this might play out, look, in any investment portfolio that contains stocks, you've got about a 60 or 70% chance in any given year that stock portfolio is going to perform in a positive way. The longer you hold that stock portfolio, the statistics show us that has had an opportunity for you to have less and less volatility in it and more of a positive rate of return. That's why at Gen Wealth, we invest in equities for the long term, and we do it as a part of a carefully crafted financial plan. And that is the key here, Scott, is a carefully crafted financial plan to put all of this information that we've been through today in context. And you only do that by working side by side with an advisor and walking through a process of making sure that you have the right investments working for you on the right timeline for your retirement or whatever your goal might be.
Yeah, and for almost everyone who comes in our office, the goal is to reach true financial independence, whether that's through retirement or being able to step into a part-time career and not worry about what they're making because they have enough income coming from their investments to support their lifestyle for the rest of their life. And that's really the ultimate thing we're trying to get at here with the plan. And it doesn't make Outlook 2024 irrelevant. It just provides some short-term perspective to help you be prepared to weather a volatile storm in the short term for the long-term payoff.
If you know what to expect, if you know what's coming down the pike, then you're much more apt to be settled with that, understand it in the context of your plan, and not make the wrong decision at the wrong time for the wrong reason.
If you have any questions about Outlook 2024, you want to reach out to an advisor, or you'd like to get started towards your path to true financial independence or build that retirement income strategy, a Gen Wealth financial advisor is here for you. Thanks for joining us for Outlook 2024.